Well, hello everyone. My name is Chris Weston. I am the head of research here at Pepperstone, and this is the last in the presentations and the interviews, the conversations that we're having to do with algorithmic trading, systematic trading, and a touch on machine learning. And it's really exciting because I've got an absolute expert in this who's been involved in it for a long period of time. Has some really interesting insights with him. I've studied his work. I've had a quick look at his work. I've had to have a look at his work, and we had a chat, and I think he's going to have some really, really invaluable insights. It's Nitesh Khandelwal. He is the CEO of QuantInsti, and we're talking today about the past, the present, and the future of algorithmic trading. I've got a bit of feedback in there. I'm not sure if there's anything we can do about that. Yep. Okay. Cool. Right. We had a technical glitch. This is the beauty of live webinars, I guess. Can we just bring back the disclaimer, please, just so we can get that one out of the way? Hopefully, everything's a lot smoother. Okay, so everything that you can see here, or everything that's going to be said today should be considered general in nature. Whatever I say, or what's more important is what Nitesh says, should be not considered personal advice. It should be considered as general only. And obviously, anything I say does not represent my employer in any capacity. So, okay, if you could just take 2 seconds to have a quick look at that, that'd be awesome. Okay, let's crack on. Nitesh, really lovely to see you and talk to you today about the past, present, and future of systematic and algorithmic trading. Why don't you give everyone a bit of a background as to the organisation that you're representing, QuantInsti, and all the other sort of areas of systematic trading that you're in as well.
Perfect. Sure, we'll do that. Thanks for having me over, Chris.
Pleasure.
It's a pleasure. And hello to everyone who's listening to this session. So just to give a brief background, I, along with my colleagues from my business school, my batchmates from business school and some seniors from technology school, we had started off with something called iRage in 2009. So in fact, last week, exactly a week back, we completed 12 years of our existence. And iRage is into algorithmic and high-frequency trading primarily. We are the clearing members and the trading members of the exchanges in India, and contribute a decent percentage of volumes through our proprietary trading activities. It's largely into market making, as well as many different quantitative methods of trading. But yes, it's a very small subset of the overall vast world of systematic trading. But whatever we do, it's systematic. There's nothing that we do which can be discretionary at all, given that everything has to be done through machines and in a very small time frame. So that's there. We also have other institutional activities within our group that we had started, which includes around fund management and other advisory businesses. I was leading the trading and investment business from 2009 till 2016, based out of earlier I was based in Mumbai, later in Singapore, and then 2016-17 onwards, I have been focused on our other venture, which is QuantInsti, and it's something which was always very, very close to my heart. We started QuantInsti in 2010, so when the opportunity came to get into a position where I can lead it from the front, I was like more than a little excited. I was enthusiastic. I was like confused. Yes, this is the day that I really wanted to do, because it's not just the trading, but creating an ecosystem which can serve like lots and lots of people who are interested in this domain of systematic and rather quantitative and algorithmic trading. So that's where it started. QuantInsti caters to more than 1 million people every year who are looking to learn about about algo and quant trading. We have three primary products. One is executive program and algorithmic trading. The certification programs, basically, which is a 6-month long program, and focused on targeted on the working professionals, typically 5 to 25 years of work experience. And then we also have self-paced learning initiative Contra, and recently we have now also come up with an interesting platform which is freely available for everyone, Blue Shift, where you can trade, backtest, research, anything related to any type of strategies that you want for US markets, for FX markets, Indian markets, all of that. So that those are the things that have been keeping us busy, and yeah, love to talk more about this domain.
Yeah, cool. So you've got a 360-degree sort of visual on the trading world, and the systematic. So iRage is quite interesting. You mentioned that you do a decent amount of flow. Sort of just, I'm not sure if you can pinpoint numbers or anything, but I'm just trying to get the idea of scale here as a participant. In terms of that flow and managing the flow. So is it a big clip of the daily transactions going through?
I think I would not say huge, but yes, definitely we definitely do a few percentage of the overall exchange volumes in India, and that's through our proprietary. So it's not the client flow or it's not the investor business, but it's a prop business. So which does like huge amount of orders that we send, probably few 10,000 to few 100,000 orders every second that are being sent out, and yeah, that's there. In specific asset classes, some of the asset classes we have like double-digit percentage share probably. Yeah. So,
and I'm interested about India as well. I mean, as a finance hub, you obviously don't hear less about it than London and New York. I'm coming from Melbourne, which is not a particularly big player in the world, but tell me about India's involvement in the financial landscape. Is it an up and coming centre, or is there a certain town, a city like Mumbai, for example? How is India's role in the financial services world?
I think India has been, it's one of the leading emerging markets, growing markets, you can say, right? And we do have like exchanges, like National Stock Exchange of India. So that's one of the biggest exchanges globally. In fact, it's the #1 derivatives exchange in the world right now, with the amount of the like kind of derivative volumes that get traded on the exchange. So so that's been there. So the financial markets have been developing quite reasonably well, because the structure is quite, you can say, well laid out. The policies are pretty much a lot clear, and there are safeguards which has been well thought of by the regulators. So I think it's a platform where when the opportunity came in, when in the early 2000s, or rather mid 90s, when that wave started of liberalization and economy opened up in India, I think the financial markets were a big part of it, and they took up quite well. It has been growing at a massive speed right now. In fact, for the last few years, and the Indian markets, the overall financial markets, the volumes, everything, still I think a fraction of what is there in the developed markets like US, but I think it's catching up. And it's reasonably big enough now to attract all the global biggies in the market.
That's interesting. I hear so many people who are incredibly bullish, not on India as a place to invest at the moment, and it's one to got to look at much more readily, I think. But interesting to know the connection between iRage and QuantInsti. So with iRage, you're prop trading the market, high frequency, and we'll come into some of those concepts from an institutional perspective in a moment. But when you're teaching your students from around the world with machine learning and algorithmic setups and bits and pieces, do you apply any of the same teachings? How does what you've learned from iRage and the sort of styles of trading and systems that you run, is that something that you then share to your students as well?
So what we do in iRage and what we cover in QuantInsti, they have independent, you can say, the thought processes, which comes in, because iRage is like everything for self, right? So everything for self, not in the selfish way, but more in terms of everything for ourselves. We don't have any clients or any services business there, primarily, especially in the core business of trading. So that phase, it's the technology, the methods that are used a bit different as compared to in QuantInsti, where we are trying to cater to a wide range of audience, wide range of people who are coming with different expectations, different requirements, and helping by creating systems which can serve them well. So that difference lays, and I think in QuantInsti we have tried to put up our learnings from iRage in creating those systems. But I'm not saying that we take up the algorithms from iRage and put it up there on in QuantInsti and we use. No, that's not. It's a totally different thing, and of course, that would not be aligning the interest of everyone in everyone's interest. So I think that phase, what we have definitely done is that we have taken up the learnings from how the infra can be built, how the strategies are built, how those how the systems are designed, right? And try to put that across into our courses, into our ecosystem, that hey, you can learn about these things, and this will help you create your own thing.
Yeah, nice. We'll go into your journey in a second, but it's interesting. I just want to sort of touch on a point, because I want to understand how you feel about this idea that, I've been talking to a lot of people who are giving systems based on mean reversion, breakouts, and trend following and various factors. But a lot of these people have been saying, a great mean reversion strategy, and it still works this day, is, wait till, let's say, the S&P futures are above the 50-day moving average, and then we want to wait for the 2-day RSI to fall. So we're basically buying weakness within an uptrend. And I said, well, it sounds like a pretty simple situation, and I think everyone knows about this now. Has your edge been diminished because everyone's doing this, right? Everyone knows this worked at one stage. Does that now become less effective because of that situation? So with you guys at the prop firm, how much do you safeguard your edge in the sense that if it was to come out, then if other people were to use it, would that edge be diminished?
Good
how
question.
Do you quantify? So how would you quantify a statement like that, if you can?
For any strategy, for any method to perform, I think the word that you used is quite important, which is edge. So which is also can be a way of saying your source of alpha, right? What is your source of alpha? Is it working because you've got massive, amazing technology? Is it because you have access to information that you can process much faster than anyone else, that is having a latency advantage? Do you have that? Or is it because you have come up with some code or some strategy? Now, code as in, I don't necessarily mean the programming part of it, but more from the perspective of that some formula or some strategy logic that you have come up with, which is really different from what everyone can think of, or something which is dealing more with your research capabilities, right? A better option pricing methodology, say, for example. If you have got that, your how much of that edge will diminish by more people joining it is more of a function of that. If it's, say, for example, speed, if it's latency, if other people join in with faster speed than you, then you're zero, right? So it's a race. Whoever is the fastest, that person wins. It's not like that they will reach and they will distribute the winnings. So that's not going to happen, right? If it is more to do with the alpha, is more from the coming more from the strategies logic, right? So some logic where you are enhancing your risk to return ratio in your favor, then in that case, that can probably take up more competition, right? So you might not get your returns, might go down by X percentage, but they will not be gone altogether.
Yeah, it's interesting you talk about that latency task. I mean, you used to hear when this idea of high frequency trading was coming up, many years ago, you'd hear all about these stories about people putting these massive masts out by Dover so they could reach out to a stock exchange and get information far quicker and be like the fastest high frequency firm. So I guess, I think your technological edge is something that we absolutely need to discuss in this situation here. But I've got a question here from Parser, and he writes, "I've no idea about programming. How can I start to write a systematic program algorithm? Thanks to guide me through." So, with what you guys do at QuantInsti, do you have to come there with a basic programming knowledge to be computer literate, to have an understanding of statistics? I'm sure it's helpful, but is it a prerequisite?
So I think if you want to program strategies, you got to have some programming skills. So that's required. Now, does that have to be? So programming happens at different levels, right? So first is where you're writing just a pseudocode or a logical flow, right? It's a program, right? You're instructing the machine or some software to do things that, okay, if this, then do this, something like that, right? Now, first thing is that you need to have that logical flow that has to be very clear. That's needed. Now, how to put that logical flow into a system? Generally use a program for that. Now, that program can be Python, it can be a Visual Basic, it can be some visual programming language, or it can be C, C++, or it can be FPGA or other hardware programming languages also. So it depends on what your objective is, but you will definitely need some level of programming. How to get started on that? Pick any programming language. Python these days, of course, has been vastly popular, has been getting more and more popular for the last 7-8 years now, thanks to the data science revolution that has been happening. But yeah, I think that is one thing that I do not say that, hey, you do not know programming, it's not a problem where you will come and start building algorithms. How will you build algorithms if you don't know programming? So the answer to the problem is that, yes, you need to learn that. Is it difficult? No, it's a function of how much time and effort you are willing to put. If you're putting in some effort, some time, I've seen far too many people picking up those skills, but of course, with a reasonable amount of effort and time that they have spent on that.
Yeah, cool. So if I came to you and I was like, well, look, I'm really well versed in the idea of backtesting. I understand the nuances, what creates a robust backtest, overfitting and all these factors. And obviously I knew all the indicators. I had a fairly good statistical and quantitative background, but I just didn't know coding. Is it just a matter then of, could I come to you and have someone code it for me? Or is it just, right, I've got to go and spend however long it's 6 months, a year to become a proficient Python expert? Or is someone there who you can come up with the ideas and they can do it for you?
So there are two ways, as you rightly mentioned, that people look at it. One is that someone will code it for me. Now, the problem with someone coding it for you is that that code is going to be an IP, right? It's going to be intellectual property. If it is something that is a bit too valuable for you, you might not be that comfortable in giving it away to someone else. That's one problem. Another problem is that if you don't know programming and you say that I want to do this and this, the guy is going to program that for you. But the problem with programs is, or the machines, is that they don't have common sense. Right, so they will be as intelligent as you program them to be.
That's right.
And if you don't understand programming, there is a very high possibility that you will leave out some common sense points which are very obvious to you but are not obvious to a machine. And if the programmer does not know that, it's going to it might create a mess. So that's the second point. So you do need to know a bit of programming, even if you're going to outsource it to someone. But if you are looking to learn by yourself, and it's a life skill now, right? So swimming or driving or programming, I guess it's becoming like that. But if you want to learn 6 months to 1 year, you will get started. It will take probably a couple of years before you can say that you have a certain expertise in the trade, especially if you're someone who is working on the side, right? So I would not say that it will happen right away. as a part-time thing that you're doing. But in a year to two, yes, it's something that you can get a reasonable expertise.
And if I'm coming to you, and let's say I've got some ideas. When you're backtesting and creating a system, when you're creating a robust system, where do you start? I mean, is it getting a ton of data and then data mining for something, or is it, I want to create a mean reversion system or a breakout strategy or whatever it is? Do you start with a strategy and then build it up from the bottom and then back test it, or do you data mine? Which way? What's your preference? What does backtesting mean to you as well?
I think first thing that I got to do if I'm backtesting a strategy is create a plan. That's way too important, because it's very logical to think that getting started with the data that you need is going to be the first step. Not really, because your strategy, you need to understand that what all data points that you need at what frequency or what latency do you need to adjust any data, especially say, for example, if you're building a latency sensitive strategy, you're getting the data, you might need to adjust that data for the latency that your systems have, right? Because every millisecond, every microsecond is important. And if you do not, so like I must share this. So this is one common challenge or the error that most of the new joinees make when they join, say, our HFT system or HFT shop, is that they will come up with a strategy and they will show that, hey, and they do really amazing backtesting, everything, all the check marks done. And they'll say, hey, this is such an amazing strategy and so much alpha that is there in this strategy. And using the systems, we can just win the whole market. So great. But the only problem almost always is that they have not included the time it takes for the order to go to the exchange and acknowledgement to come back. So like those few hundred microseconds that make or break the whole strategy. And once you adjust for that, the alpha is gone, right? So if you're backtesting a strategy, before getting the data, you need to identify the nuances around the data. So that's something that we need to do even before you get the data. But once you have got that, you got the plan, you get the data, the source, and then you build a model which can help you in putting the hypothesis under test. That this was my trading hypothesis. This is what I was saying, that this is what we need to do, and then validate that hypothesis. So that's quite important. I can, in fact, if you want, I can take an interesting example around that.
Yeah, show away.
Okay, so say for example, if you're looking at a mean reversion strategy, statistical arbitrage, pairs trading, right? In that strategy, what you will be doing is that, for example, I want to trade a pair between, say, Aussie, Australian dollar, and Canadian dollar, right? So both are, I have done some qualitative research, both are energy-oriented economies and developed markets and this and that. So okay, they look like a good pair, and it might be interesting to get a decent alpha from that. Great. So typically what you will do if you're not a even if you're a systematic trader, or if you're more technical oriented, technical analysis oriented, what you will do is that you look at the charts, you'll see that, hey, both seems to move together. One of them is at a resistance, one of them is at a support. So probably I will buy Audi and sell carry, right? So let's do that. And once they revert back, I'll exit the trade. Now, if I were to build a system around that, I will probably look at the whole thing way too bit differently. First thing is that you're saying that both seems to move together. That seems have to be highlighted and addressed first. So that's my hypothesis, right? So I have to run some test. Maybe on the time series, I can run the co-integration test, say ADF test, or some test that I can put in, right? And say that, okay, they are co-integrated, which means that by definition, they're moving together. Perfect, great. Now, next is that, okay, but when to enter, when to exit, and first create a pair ratio or some ratio around that, something that is tradable, right? Spread or ratio, whatever it is. You create that. Once that is done, then you say that I need to figure out when to take the position, whether it is 2 standard deviation away from the mean or 3 standard deviation away, what it is, right? So you'd go and do some curve fitting. If you do whole curve fitting, you're gone, right? So you need to define the in-sample data, out-of-sample data, make sure that you're not doing curve fitting. So all those things you have to do. So you have so far used various statistical methods to come up with a model, and now you're testing and seeing the results. After that, say you find that, okay, everything is well tested, how to go next. So then you will be saying that, okay, I will be trading this pair and I'll be sending order in one of the exchange on one of the assets and covering the another one when I get the fill. Now there you have the latency problems as well. So which one to send orders first, right? So you will say that, hey, what I'll do is that I'll send the order which is the leading leg, right? How to determine that this which one is the leading leg? So I will say that I'll run some causality test, Granger causality test or something, and then I will get that, okay, Audi seems to be the leading one at this point of time. I'll send orders in that. When I get a fill, I cover the other order so that my latency is minimized, my slippage is minimized, and I end the whole process. And then I send back my report to my model again as a feedback that what was the slippage, what was the thing, and I have to optimize my model. So that's how a strategy flow model would look like when we are testing it.
So would you? I love that strategy of the arbitrage or pairs trading on the currencies. Would you do that something shorter term, for example? So let's say that Aussie dollar has moved up on an intraday basis, moved up 1%. On maybe S&P futures have gone up X, and the beta is that. So Aussie dollar's gone up, and then you've seen Kiwi dollar going up by 0.8%, and you're like, well, generally speaking, the Kiwi is going to be somewhat more of a powerful move. So you might do pairs trade between those two based on historical data which you've looked at, and then you're just going to look for a tightening of the two performances together. Would you do a strategy like that on an intraday basis, or is it more of a long-term situation?
I think either can be done. So you can try for long term. You can try from the intraday perspective as well. Now the key thing here is that if you're doing intraday, say for example for the two assets, how you are testing that, because ultimately for us. For me, as well as for whatever trading ventures that we have run, we have always tried to make sure that trading has to be boring. So if trading is too exciting, if it is too many variables open out in the open, then it's the probability of making money can reduce drastically. So our thought process, hypothesis is that if you make trading boring enough, then the probability of success would be much better as compared to when it is like giving you exciting you all through, right? So you have to make sure that the data that you're testing on, the strategy, whether it's intraday or whatever strategy it is, if you are testing it and your live results are mimicking what you're backtesting, perfect. So then that's what, it's fine, and it doesn't really matter whether it's intraday or overnight from that perspective.
Yeah, cool. Right, I want to sort of go on a bit of a journey with you around algorithmic trading. We talked about this being the past, present, and future, and we've just sort of gone on a chat, which has been great. But I want to take a step back and look at your involvement in algorithmic trading, but how you've seen the development and evolution and where it's going to go. So we take a sort of step back and we start with institutional trading. I mean, obviously institutional is massive. We can't just take broad brush, hedge funds, pension funds, real money, all those factors. But yeah, it's fair to say that when I started in my career in investment banking in the late 90s, there was bits and pieces going on, but obviously the technology wasn't there. How have you seen the broad institutional adoption of using algorithms, and how much of an advantage do you think that institutionals get? I know algorithms are a hugely broad situation. We used to use them very much for just best execution, really, or tracking VWAP and all those factors. But nowadays it's so broad. But given the technology that institutional traders have, how much of an advantage and an edge does that give them?
So I think if I look at the institutions which are the funds, hedge funds, managing say billions or a few hundred billions of dollars, the edge that they are playing on, if it is something which is technology, generally it's their HFT divisions which are doing that, right? So if the edge is technology and infrastructure, that's where it goes. If the edge is more of research, that research, mind you, is becoming more and more data centric. So the research is more of how you are mining the data, how you're interpreting the data, and either whether it's you who is interpreting the data, because now it's the machines who have to interpret the data directly, even in the higher latency space, which is low frequency space as well, because research, that data is becoming massive and massive. So given that, I think the way journey has been happening is that it started off with the execution part, right?
Yep.
So where you are just using the algorithms and technology for the execution, and that has then started going more and more towards first the execution, then the market data and other data analysis, you can say, and then the CP engine, the core strategy part, right? So complex event processing engine that is there in a server in any algorithmic trading system. I think it has now reached in that stage for almost most of the funds as well. The reason is simple, that earlier it was only required for funds who were trading automation, arbitrage strategy, market making, all those kind of strategies. But now with the huge amount of data which is becoming available, the machine learning which is coming in and taking nearly the center stage, if not the center stage already, right, for a lot of strategies. So I think it's becoming important for them to use technology all across the strategy flow or their ecosystem now. So that's happening, and that's where we are moving towards, which is more towards adopting the technology from the research analysis point of view as well, and not just the execution part of it.
Cool. And then we touch on retail as well. Obviously, they don't have the same technology as the high frequency trading firms, nor will they ever get anywhere close to that situation. But in terms of what you've seen from retail involvement in systematic, what's been the biggest advances that you've seen over the last 5, 10, maybe 10 years as well?
I think it has made them the incredible leaps and bounds in terms of the learnings that they can have from the mistakes. So say for example, if I am a retail trader, I did something, I traded something which I should not have had, right? And I have lost big money, and when I go back, while I've lost money, I'm really not really in a shape to learn anything from it at that point of time. But even later on, there's too many filters, too many screeners in my mind to remember what was it or what were the reasons. But with systematic trading, what has changing is that you're able to learn from whatever mistakes you were doing, because you can analyze that. If it is systematic, you can analyze it. If it is discretionary, or if it is something which was not really using those the technology systems, then I think those trading systems, it would have been very difficult to pick up on the learning. That's the one big advantage that I'm seeing. But of course, there are many other things in which the traders are learning from the traders are not learning, but more from the perspective of the using the technology for their research as well as trading. Now, interesting thing that was happening earlier was that if you are a retail trader, if you want to run some simulation or some big data heavy crunching, right, big crunching involving a lot of data, you didn't really had much options, because for that you will need some server. And the moment you need a server, for most of the retail, it is out of like few $1,000s, which is like out of their capacity to invest into those things. And with the advent of clouds, Amazon, AWS, Azure, all those systems which are coming in, you have that available on the go, right? Whatever time you want to use it for, you can pay few dollars, few $10, and you can get those things done and tested. I think that's another big, massive advantage that has come in for the retail, which is kind of now pulling the power that was kind of exclusive to the institutions who had access to that kind of infrastructure. Now that infrastructure is in a way getting shared, right? So that's I think those are the few things which are helping retail traders a lot with these systems now.
Yeah, I've got a question actually, and we'll come back to that point, but I just want to sort of come in with a question.
Sure.
I think we got a question from the audience touching base on that, the arbitrage pairs trade effectively. I gave a bad example. It was a bad example, but I said, Aussie dollar and Kiwi dollar. So the question is would you use a correlation coefficient as a filter in a pairs trade? Would it have not just been easier for me to have done Aussie Kiwi, which I guess it probably would have done, yeah. But how would you go around then defining which currency pairs you would do so that it doesn't just become easier just to do the cross rate?
I think when you're picking up on any two, so I would not look at it as okay. So when you're looking at, if say, two currencies or two asset classes, first thing to do is maybe run some qualitative checks. So why should they be running together, right? So why should they be getting moving together? That's there. So that's more from the qualitative perspective, that if it is, say, for example, stocks from the cement sector, so that there is a fundamental reason why they should be together. Similarly, if it is, say, Australian dollar or Canadian dollar, the reason is that, okay, minerals and a few other things which the economy has heavy reliance on, so that's abundant in both economies, right? So there is something underlying. That's having done that, then you next go to the quantitative aspects of it. Correlation is generally not the, maybe for filtering you can, but there are too many cases of spurious correlation which might come in. So generally the thing that you go for or try checking for is co-integration, which helps you understand that whether the two time series are moving together, right? So if they will be coming co-integrated. If they are, you can run the co-integration test and check for co-integration. If they are, then they are more likely to exhibit pair trading characteristics as a pair, as compared to, say, if I just run a correlation, it's it's not very likely, but it's quite likely at least to get into spurious correlation.
Yeah, fair enough. Okay, so back onto the looking back aspect. In terms of retail traders, and they come to you, and what you've seen over the years in terms of their knowledge, are they weighting their models and their systems more towards quantitative methods and statistical methods? You talk about co-integration, or are they building models based on oscillators, indicators, and more sort of traditional technical analysis measures there as well? Or is it a combination of both? I would imagine, 5-7 years ago, most people would have come and said they tried to build a model based on, Bollinger Bands and various factors. But now, is it more the weighting's coming towards more sort of quantitative measures?
Yeah, I think that has been the trend. Of course, when someone starts their trading journey, and if you have been to the markets, you've heard about all these things, the various indicators, bands, and all of that, right? So, and if you're even coming from the fundamental side of it, you have heard all about the screeners, fundamental screeners, and news-based screeners, or economic data, all of that. So your first thought or the first ideas generally are based on that. You try them out. For most, it may not work, right? And then you try to pick up other skills. Now, what we have seen as a trend is that more and more people are coming in to learn those trades. That, okay, this is probably not enough, I want more. So I don't think that they are looking to replace that. Hey, I don't want to do away with stochastics or the oscillators, and I would rather switch to something entirely different. What they're looking for probably is that they're looking to add on to their arsenal, that the more techniques, and the techniques which can further help them fine tune the results. So, for example, a lot of people are coming up with basic technical indicator strategies and now saying that, hey, I want to apply some of the machine learning techniques to help improve those strategies, right? So those things are happening, and we are seeing them happening more and more, way more, as compared to, say, 10 years back or 8 years back or 5 years back.
I love this idea of machine learning, because my knowledge of machine learning is not great. There's a couple of people at my work who are very proficient at it, and I'm starting to learn a bit more. But for the benefit of people who are watching this, who are pretty slim on their understanding of machine learning, how does machine? So if you've got a backtested strategy which you've systemized, how does machine learning take that to another level?
So machine learning is essentially helping your algorithm learn from the way it is running, the way it is interpreting the data, way it is doing the analysis, and learning from it, right? So for that, there are multiple ways in which machine learning is being deployed into the financial market. So strategy, yes, but even more is risk management, portfolio management. All of those aspects are also becoming quite important, right? So there are unsupervised learning methods which you can use to figure out that, to have a very diverse portfolio, right? To identify stock from the global stock universe, for example, and automatically identify pairs, which will help in an optimal portfolio for your system, right? But similarly, on the prediction side as well, what we are seeing is that people are using it, one, from the perspective of predicting what the next future price would be in a short run, right? As well as trying to predict the overall direction, right? From the machine learning perspective, both are very different problems. One would be probably a regression problem, another one would be a classification problem. But people are trying to use machine learning to identify that what is the likelihood of market going up or down, right? So, or market going to be in trend following or in mean reversion mode, right? If you are able to identify that, then what you can very well do is that you can try to pick up those strategies which are better aligned for those type of markets, right? So if it is you're predicting that the market is going to be in mean reversion mode, in that case, you can pick strategies which are more statistical arbitrage oriented rather than trying to run the momentum strategies at that time, right? So, and vice versa if the market is in the momentum. So that can increase the potential returns for the strategy just by adding that kind of filter.
Yeah, great stuff. I've got a couple of questions around machine learning. We've got Alex. He's written. Could you go into more details on the strategies that are used in statistical arbitrage or the machine learning models that are implemented?
So I think in the arbitrage space, in fact, we have a dedicated session in our 6-month certification program on using principal component analysis in statistical arbitrage. So the idea is trying to identify those components and using them in your routine day-to-day statistical arbitrage strategy and enhancing that, right? So that's one way, which is purely you can say specific to the strategy paradigm itself, right? But there are more ways in which you can also try to predict the single stock or the single asset movements as well, right? So that's also there, and we have seen a lot of our machine learning team, they do try to keep on trying different methods. They run the models for many days, keep them running, and then come back with, hey, nothing happened, or hey, something happened, right? Something happens rarely, but it does happen. When it happens, then it's just beautiful, right? So
Right.
yeah.
Okay, cool. And then we've got another question here about machine learning and also the curve fitting. Is machine learning more likely to be highly fitted?
So ultimately, I think it would be a function of how you are building your model. Okay, so curve fitting is a function of the fallacy at the part of the person who is creating the model, and it's irrespective of whether you're using machine learning or without using machine learning, a simple model as well. And I was like talking about earlier that when you're deciding on entry and exits for a statistical arbitrage strategy, I mean pair trading strategy, right? You can curve fit it by saying that, hey, 2.217 percentage, 2.217 standard deviation is when my entry should be, and my exit should be at 1.28 standard deviation, right? I have run that. You may have done it on the entire data and found out that this seems to be right. The number that is giving the best result. But the problem is that that's just the history, that's just the past. It does not it mean that it will give you those kind of returns. And mind you that most of the strategies, when you hear 300% return, 800% return, on the backtested scenarios, this is most likely the scenario which we see that's because you have curve fitted perfectly, right? So what you need to do is that you need to break down the data. So same thing applies in machine learning. Like in general backtesting, we break it into in sample, out of sample data, right? In machine learning, you put it for the training data set, right? So you take the training data set, try to train your model on that, and then try to see if you are able to replicate those results in the normal in the rest of the data as well.
Yeah, cool. We get, it's really interesting. We get a lot of questions on these shows about mean reversion. I think it does seem to be that everyone has a preference for mean reversion for one reason or another. When you're talking to people about mean reversion, when your students are building strategies, what are the sort of characteristics that you see? I don't expect you to say, here's a strategy for you, but what are the characteristics that you see working much better? I mean, I've got a question which maybe ties into this. And are low beta stocks, low beta effects indices more suitable for mean reversion? We talk about volatility regimes in mean reversion. So there's two parts to this question. One is a very big one, which is, what is your advice for people building mean reversion structures? What has worked for you? And then the second one is beta and movement in the stocks.
I think the point that you mentioned about the volatility angle, how much volatile, the second part of it, right? So how volatile the stock should be, or whether they should be low beta ones, which we are likely to do better or not. I think the best way to look at it is see how frequently the co-integration keeps on getting broken between the two asset classes, between the two time series, say, right? If it is too often, then your hypothesis is probably not strong enough. They probably are not co-integrated in that sense, right? For most of the time. In fact, when we are testing for co-integration, we advise that you test it for multiple time frames. You don't test it for just one time frame and say that, hey, it's coming co-integrated now, they must be moving together. Might not happen, right? So that's one thing that is important to see, that how frequently the co-integration is getting broken. Volatility, more volatile, less volatile, I think those are things that you can adjust in your model itself. So say, for example, you can put on parameters which can tune your entries or exits in proportion to how much volatility it is, volatile the overall pair is, right? So you do not want too many trades, you do not want too few trades, right? So you will optimize. That's part of your backtesting and optimization process.
So how would you do that? Would you target a realized vol level or an implied volatility level, or how would you measure and target volatility?
So I think it's more a function of what is your target return. So for example, this is very, very common, like mean reversion or momentum, all sort of strategies where, especially on the client side, if you're managing funds for others, where the target expectation or the return expectation is not your own, but of your client, that, hey, I want this much returns. Now, talking about returns in itself is not of much significance. It's at what risk, right? So you can actually target, generally, that's one way. There can be multiple ways, of course, but how much target returns you are looking for, right? And that can help you define what is your volatility levels that you should be targeting.
Yeah, fair enough. I get that. Question from Ron. And actually, I was thinking this as well. So there must be other people here thinking of this as well. We talk about getting a system and then developing it and then putting it through machine learning. How similar is machine learning to optimization?
So optimize, when you say optimization, you're referring to optimizing the.
Yeah, so if I've got a very simplistic basis, I've got, I'm doing a moving average crossover system, for example. I'm doing, 7s over 5 days over 20 day, and I want the RSI to be moving higher But then I get a result, and then I then decide to optimize it, and it tells me that I would have been doing better doing the 7/15, for example. How much crossover is there between the optimization process? Is it just that machine learning is learning as it goes on, or it's just not spitting out those parameters that you should be using?
I think it can be while it can keep on going while you're implementing it. But in most of the cases, what you will be doing is that you'll be using, especially from the retail trader perspective, you'll be learning, you'll be using it more at the learning stage, that is at the training stage, initial research part of it. So probably when you're optimizing, the more important optimization part for you would be that 5 or 20, that coming up to that 5 or 20, or some variation which is based on certain underlying parameters which you can get on the go. But the formula or the final output that you have got, that okay, if the market is this much volatile and this is there, and whatever 2-3 different parameters which are there, I would be using this 5 or 20 or 7 or 21 or whatever it is, right? So that's there. So that's where we have seen more individual traders using it rather than trying to deploy in the trading systems on the go, which can be a bit more resource hungry as compared to when you are trying them on the historical data.
Yeah, cool. Alex writes, what inputs are used for machine learning? Is it just historical prices, or does volume and other technical indicators go into the model?
So you can actually, so it's a number of features that you can use, right? So every input parameter that you're giving, that's a feature for a machine learning algorithm. Now, it can be prices, sure, but just giving the less number of features that you have, the more difficult it is for your algorithm to learn, right? And that's one of the big challenges which are there in the Financial Times series. The number of variables or the number of features are too less, right? So this is a very, very common practice where you actually try to come up with lots of different indicators, technical indicators or other indicators, and try to feed them as features into the program to help it learn more. So yeah, I think that's something that definitely is done very actively, and you can definitely try that. So depending on which algorithm you're using, but yeah, that can give some interesting results.
Great stuff. We're getting loads of questions, which is great. It really sort of feels like there's people who are absorbing what you're saying here, Nitesh. I want to sort of touch on something that's really close to my heart, and that is market structure, or the microstructure of the market. Everyone says, Chris, earnings don't matter. Well, I disagree, because if you overlap a chart of the S&P and the earnings that we've been seeing, they are quite well correlated. But obviously buybacks are a big part these days, liquidity, all of these factors coming through. And then you've got flow as well. A lot of people who are, obviously you've got passive funds, but you've got a lot of flow coming from market makers these days who are delta hedging. And we saw some statistics yesterday that individual options now equate for more notional than the actual people buying and selling the underlying. So with that in mind, and that's changed significantly over the last 10 years, and it will be different in the next 10 years as well. And if you don't understand flow, then to me, you don't understand markets, because it is really just about flow is a big part of it. Earnings we talked about as well, but flow nowadays is really what's driving that, and that's really been a function that's really driven out of what we saw out of the pandemic. People buying call options and going into the market, everyone having to delta hedge, and that drove them even higher. But how does that, with that in mind, does that macro, the sort of backdrop, the flow structure, does that come into your system design? How does that influence you?
Yes, of course. That's a way too important, actually. In fact, you mentioned for the order flow or the overall flow systems, I think that is what dictates the short-term movements, right? So the long-term other fundamental changes and other things that, if correct, that will still take a while to sink in. So if you are trading, say intraday trading or other things, I think flow is way too important for you. Now, when you're looking at the flow, one mistake that we have often seen, especially in markets which are not very developed or not too liquid across asset classes is just looking at the flow from a single instrument. So for example, if I'm looking at a stock, I'm just looking at the flow that is coming in that particular outflow in that particular stock. Whether I should be looking at, like you mentioned about options, right? For stock option, for that options and futures, and even ETFs around that. So what is the overall interest level in that stock? That will actually going to define the demand for that stock in the short run, right? Because for a firm, say for example, if I'm doing arbitrage, right, between on a particular, and as a trader, my mandate is that these 10 stocks, for each of those stocks, I'm looking at all the different instruments which are related to that stock, right? So that I think becomes important, which is often missed out, I think, by a lot of people.
Yeah, great stuff. I've got a good question here, but I want us to explore one other point. What we've seen this predictable pattern that happens going into options expiry on the S&P. I don't know if you've ever noticed it, but you always see the situation going through where the market's got a certain gamma level, and markets, I think the last 6 months have fallen into options expiration. It's so become like the most predictable trade that you've actually seen. It's become so predictable that people are now trying to work out the month ahead, where do I start front running this trade? Because you know that dealers are short, they're short gamma, and there's this big move coming through. And go and have a look at the daily chart of the S&P or the S&P futures, and just see the week before options expiration, bang, down it goes, bang, down it goes, comes up. So, I mean, when you're talking about machine learning, is that the sort of thing in terms of that predictable price action that maybe machine learning could pick up?
I think machine learning is essentially trying to learn or identify the patterns which are not very obvious, right? So if there are obvious patterns, you don't really need too much of algorithms to go into that.
I've picked it up without an algorithm, but
yeah, exactly, right. And but there are a lot of hidden patterns which are there, which are not obvious to those who are using or who are looking at those markets, right? So when you're feeding huge amount of data, the best use of machine learning is one of the best uses is definitely trying to spot the patterns within that data which are not very obvious one, right? So that's there. So I think this pretty much would fall under that, where you are using it to identify a specific pattern of activity which is happening, right? So if you're saying that every expiry there is something which is happening which only repeats at a certain point of time, right? And a certain kind of thing which repeats in itself, right, after every certain period of time, then I think that can be identifiable, even if you tell it that, like, hey, I don't know what it is happening, but it will still be able to spot that. In fact, that's the basic of unsupervised learning that we have, right? So that's there.
Yeah, great stuff. We've got a question from Deep. I'm not sure if this fits into what you've been saying, but I'll let you answer it. How will your system? I've just lost the question there. Sorry. How will your system help my trading without me interfering with it and your monthly cost?
Oh, we don't offer any system, so that's there. So we what we do have is we have this platform Blue Shift, which is no cost. It's a free platform which is
Do you want
out
to show
there.
it? Should we have a look?
Sure. Okay. Yeah. Why not?
Can we have a look at it?
Yeah. Sure. Absolutely. I think it's something like this. Can you see my screen?
Yeah. Yes. Yep.
So this is Blue Shift, where you can create all sorts of strategies. I think, say I think I'll pick this. Maybe I'll pick the mean reversion one, FX mean reversion that you're talking about, right? So you are picking up using TLib, that's technical analysis library, and these are the Python code. So let me just give me a moment. Maybe I'll just start right from scratch. Maybe that will. Yeah. So if you want to create your own place, your system, or you can create a folder, you can create your own strategy. I just some random name. Say for example, if I take basic strategy using relative strength. I can build visually, or I can code my strategy in Python. So visually is if you don't know you're not very comfortable, or you do not want to go with programming, you can do that. So this is a sample strategy which has come in, right? So where it is using our own library indicators, and you can take up the code which is there. Now you can edit it. So whatever you want to do, that's doable. You can do that, or you can use one of the existing code sample codes as well. So just to learn. And say for example, if I run fx minute, and it's the date, it has the minute level data available since since 2008, right? And say if I run it till maybe sometime 20th September, I run it. So it will start running and give you backtest results that, hey, this is how the backtesting, the returns, the results would be there. I can also run a quick backtest, a new backtest, full backtest, which is, so the same thing I can run, and that can be posted for a more detailed backtest also, right? So there's something which is coming in. It will give you returns, alpha, beta, Sharpe, drawdown, right? All of those things can be given. Now, if I just go to some old maybe backtest or any strategy, so this is how it looks like, a backtest, detailed backtest, where you get all the different performance metrics, and you also get the tier sheet. You can see how the Sharpe ratio of your strategy has been moving over time, how the beta of your strategy has been moving over time, how the returns has been, histogram, or the drawdown or monthly performance has been, or even the transactions, right? So all the transactions which happened. So this is for another strategy, so that's why you're seeing some stock names instead. But yeah, I just opened that since it's already available. So you can do that, and if you want to download your strategy, you can download that. If you want to share it on social media, or if you want to make this backtest public, you can do that. So all those things are possible to do from here. I can, if I change my mind later, I can hide it as well, right? So those things are possible too. And what you can also do is you can take these strategies. Say for example, some other strategy, I can take them live as well. So I can pick on, so it will take me to the live trading engine of ours. And here you can create your own strategy. You can select whatever brokers which are available. So for example, so we are just starting off with adding brokers, and we are in the process of adding a lot more. This is just, we are just completed the core development, and now we'll be starting the outreach. But yeah, so you can do auto execution, you can do one click, and you can accept the terms and conditions, review the strategies. If everything looks good, then if everything looks good, then you can just go ahead with it, confirm it, and it will shoot into a live trading model where you can see. You can also integrate it with your Telegram app, so you're getting all these alerts over there. You can see what the code that you are trading over here, right? So this is the code. You can see all the trades which are happening. So whenever the trades are happening, it will come over here, all the dashboard, and anything cash, M2M, and the positions which are there. So all those things will keep on coming. So this is what something like that. This is what it will look like, right? So when the returns or the positions comes in. So that's there. So you can trade for US or Indian markets or FX markets. So that's quite possible. And the cool part is that you can create almost any kind of thing. And if you are not very comfortable with Python, you can always go ahead and create, say for example, the same strategy that we were running over there. We can create visually as well. And in visual part of it, so you can not just, it's a drag and drop, so you can select what assets you want to do, and whichever broker, and the things that you can do. You can even use machine learning, different models that you can create yourself, or the different features and targets, all those things that can be there, right? And you can very well, how we were doing it for using the Python, you can do the same thing for using the visual part as well. So it's like drag and drop, kind of Lego set, right? So
and is there a community here as well? So obviously, if I'm doing a list, and like you obviously got the sharing function, but is there within QuantInsti, have you got like a community where people are sharing ideas, coding, what's working, and bits and pieces?
Absolutely. So there is a community where people do keep on posting their queries or any suggestions, ideas, anything, and it's quite, I think, reasonably active community that we have been seeing more and more there. And people and it's not just like I mentioned that it's not just what QuantInsti brings in as kind of an ecosystem which is out there. So, for example, if you want to learn something, say this is Contra, the second product that I was talking about, which is more to do with self-paced learning. So if your learning goal is to apply machine learning in my trading, and if you're new to machine learning, familiar with machine learning, or I want to use new sentiment or NLP techniques, then I'm new to machine learning, then these are all the different courses which it will suggest that you go through them, right? And it will not suggest you that, hey, go and do deep reinforcement learning, right? It will say that, okay, get started with this first, and once you're okay with that, then you can go ahead. And there are lots and lots of courses which are out there, and all sorts of courses, beginner, lots of free courses as well. So if you are just a beginner who want to get started on Python or trading or introduction to machine learning for trading, I think you can try out these courses free of cost, and get started in your journey. And as you get comfortable, you can go deeper into it. And the lovely part is that all these courses, they are kind of, you could say, they're kind of integrated with the trading platform. So for example, this is how a typical course looks like. So mean reversion strategy in Python that we're discussing about by Dr. Ernie Chan, right? So this is where you have different sections. You check for stationarity, ADF test for co-integration. Then you go to mean reversion strategy. Then you start off with a video which has multiple lingual, like Spanish and English that it has, and clickable subtitles, but very small, you can say, the videos, followed by, say, whatever is the concept checking questions, you can say, right? And then it follows with the Python notebooks, and where you can try out things, and then also the interactive exercises where you are supposed to, like, given a perspective, you're given the instructions, and you can try out, like, I don't know what to do, so I'm just putting it over here, and it will tell me that, hey, some curated message that have you defined this, and this is the output which is coming in. You can try hint, and you can say solution code. You can try that, and if I put that, what happens is that it will keep on helping you the same code in a step-by-step way. I calculated the 5-day moving average for the Bollinger Band. Then I created the Bollinger Band over here. The same code continues. Then I defined the signals and short entry, long entry, then the positions, managing the positions, and the P&L, consolidate the position, and then finally the compute P&L, right? So it's the same code which is continuously coming in, and you can try and learn that, right? And then once you're done with that, you can always go and you can try out the live trading, the same thing on the live trading template as well. So which opens up in your Blue Shift or iRage PY, if you or many other platforms. And the same thing will open it up, say open existing, the same one, and the same code which was being discussed over here. So that comes over here, right? Okay. So and then the rest of I already showed you how we go about that. So you can use use the platform not just for learning or just for execution, but for the whole strategy flow process. So that's what we have. That's what have been keeping us busy. And
yeah, I'm sure. Well, it looks like a fantastic product. Few questions. Let's fire them off if you can. We're just out of time now, so I want to keep this quick fire.
Sure.
Okay, so Alex writes, I've looked into hidden Markov models a bit, but don't quite understand their usability. Could you explain?
Sorry, come again, the question.
I've looked into Markov models. Are you aware of Markov?
Mm-hmm. Yeah. The hidden Markov model, that's not my expertise area, but yeah.
I've looked into Markov models or hidden Markov models a bit, but don't quite understand their usability. Can you explain them?
So I think the primary use that I could see from these sessions, because there's a session which Brian Christopher used to take earlier actually for EPAC program, which specialized into the HMM models, hidden Markov models, for trading. And I think the key part there was using it from the perspective of optimization and prediction. But honestly, I'm not very much deep into the HMM model. So yeah.
Cool. All right, we've got Nitesh. Do you advocate dynamic position sizing when running back tests, or just a set size?
I think dynamic position sizing can be quite useful, especially when it adds to another variable that you can play around with and optimize your overall trading methods for that. So I think you can start off maybe with the fixed one, but dynamic makes sense, but make sure that it is systematic. It's not something that, hey, I'm losing money or making money, and that's letting that decide on it. But more of it's something which is predefined in the system itself.
Peter writes, what is the impact of automated systems on intraday trading? Does it mean more or less opportunity?
So I think it makes identifying more opportunities easier while making it a bit difficult to survive on the existing opportunities. So the markets become more efficient, which means that, say, for example, if you are on a desk which runs on cash future arbitrage, for example, right? So cash and carry. And this is a live example. This used to happen in India a lot, right? So in mid 2000s, there were like thousands of people who were doing that in different brokerage houses. And when the automated trading came in, of course, that is something that you can automate like right away. And that did happen. And the returns expectation, everything came down drastically. And then, of course, that meant that manually it was no more feasible. But those people, at least those who are picking up on the new things, they were able to identify more other opportunities using these systems as well. So that's I think the both sides to it.
Yeah, he's also, I think he's clarified his point. Does that mean trading is becoming more and more short term in nature? I guess it is. I mean, 80% of the S&P flow is done by HFT firms now, isn't it?
Yes, even in India, I think more than 50% is HFT firms now. But I think it's more to do with even earlier, someone had to make markets, right? Someone was always making markets, and it's just that the cost of making markets have come down in a way. So like 100 years back, it was the specialists who used to make markets in the pit trading, right? And the spreads would be huge, like massive spreads between bid and ask. Today, and that was because the information asymmetry was there, and the risk was there. So the specialist didn't know that by the time he get the cover, what would be the price would be, right? Today, with the HFT firms having servers in the co-location and others, the firms can afford to be like really, really aggressive in their codes, because they know that if something happens, they would be able to execute those changes like really, really fast. So that gives that comfort. And that's, in fact, from the retail trader perspective or retail investor perspective, that's a massive cost saving in the transaction cost, because your bid-ask spread is much less now.
I could sit there and talk to you for another about 5 or 6 questions about market making. I'm not going to. I'm going to take the liberty, because I'm the interviewer today, of asking the last question. And before it slips out of my old man memory, where do you see the? I don't know if you can answer this. It might be a bit broad, but where do you see the future? If you look into Nitesh's crystal ball and look into systematic algorithmic machine learning trading in 10, 15 years time, what's going to be the biggest advancement there?
I think the biggest advancements, so we foresee that it will be at every stage, be it your institutional level, retail level, and the market participants level, right? At the institutional or at the exchange or regulatory level, I think the big changes which are coming in is the way in which settlements and other things have been happening for a while. So I think with blockchain and other new technologies which are coming in, I think that might be a game changer, especially from, like, I'm not just talking about the cryptocurrency as such, but the overall concept of distributed systems and blockchain. So I think that's one big change, I think, which we think should be maybe happening. Another is about the retail participation. I think the retail participation is going to change drastically, hopefully. Right now, what happens is that there is too much push on what's going up, what's going down, and hearsay and tips or whatnot, right? So following the herd and other things which are there. And unfortunately, what happens is that in every bull, whenever a new bull comes in, those things comes to the top. A lot of new people come in, and then they often, when the bull crashes, which eventually it does, right? Every bull does. So then they go away, and that's like then they're waiting for the next bull, right? Now, what we are seeing is that there is a new generation of traders and investors who are coming in and who are not looking for quick money or the tips to get rich quick, right? There are still a lot of people who are there who might think on those lines, but there are a lot more who, as compared to earlier, who are not. And I think that's a massive big change, because these guys also have the capabilities now, thanks to the open source revolution, thanks to the data science methods that are becoming more and more available the freely, right? So those things are another big game changer, which will help, or rather change the way we look at the markets right now from a huge retail participation chunk point of view. So that's there. And the institutions, I think they are going to go to alternative. I think we are already seeing initially it was alternative data from the perspective of getting more you can say data from the satellite images and other things which were already prevalent but was getting prevalent in the last decade. Now there's a lot of focus which is coming on the sentiment side of it, the sentiment analysis, and using the alternative data to enhance those models. I think that's a big change that we again see, which will probably change the way we probably operate.
I could talk to you again for another 5 questions about news recognizing sentiment and the tone of voice and how that feeds into positions and bits and pieces, but I'm not going to. We've got a ton more questions coming through. Everyone's full of voice today. Nitesh, if people want to get in touch with you, if there's still people who have got questions and they want to reach out to you either about the services that you provide or maybe even some loose points around some of the stuff that you've heard today, what's the best way for people to get in touch with you?
Oh, sure. They can connect with us on contact@QuantInsti.com. So that's the default if you don't know any specific point that you want to reach out to. In case if you're looking for some services, you can reach out to sales@QuantInsti.com. Right. And in case if you are looking to connect for Blueshift, the platform, which is a free cloud-based platform, which we saw earlier. So you can connect on blueshift-support@QuantInsti.com.
Great stuff. Okay, unless you've got anything else have you got any other points you want to make known, or are you good?
Yeah, I think it's been wonderful. A lot of questions. So that was really amazing, because that keeps the conversation really delightful.
Yeah, lovely. Yeah.
And yeah, I'm really glad to see the interest in this domain. It's really amazing. It's a domain which is very, very close to our heart, and I would love to address any other queries that might be there. You can connect with us on any of these email IDs, or connect on LinkedIn or any other platforms as well. Try to be active on that, but not too active. But yeah.
Well, thank you very much. Your time you've been very generous with your time, and I for one are really interested in this space, and you've just taken it another notch higher. So we really appreciate. I'm sure everyone out there who's watched this is going to get some real invaluable information. So for myself and everyone at Pepperstone, thank you for giving up your time, and for everyone who happens to watch this as well. We really appreciate you spending an hour or so with us to go through Nitesh's mind and his thought process and what they do there as well. So if you've got any questions around algorithmic trading, obviously reach out to Nitesh, or if you want to know more about algorithmic trading with Pepperstone, do reach out to the team as well, and we'll obviously give you the insight that you need there as well. But thank you very much. If you do find yourself liking the video, smack the like button. I've got to do this. Everyone does this when you're watching YouTube videos, but it would really, really help the channel so we can do more content on this going forward. So thanks very much. And again, Nitesh, cheers for your time.
Pleasure is all mine, Chris. Thank you for having me over, and all the best and looking forward.
Cheers.
Thank you.